On this week's episode of the Investors Corner podcast, sponsored by Survey Network, me and Mike are going to talk about whether to invest money into a house or invest money into stocks and shares. So buy to let used to be the golden ticket of investing. Used to have low rates, rising prices. It used to be easy money. But with tighter regulations coming into effect around renting your property and tax implications as well, then is investing in property now dead? And is stocks and shares the new investment route that you want to go down? We'll talk about growth, we'll talk about profit, and we'll talk about effort on both sides. So make sure that you listen into this one and make sure that you hit the subscribe button if you like what you hear, and make sure that you share with friends and family as well. Mike, we're back. We're back for another episode. Just me and you.
Yeah.
Me and you. Ian, I haven't seen Ian for a while. We don't need him.
Anyway.
We don't need him. We don't need him. In this one, would you rather own a house or an index fund? Okay, and the reason why I'm talking about this,
own the whole fund.
not the whole fund, a slice of it, a portion of it. If you did own an index fund, then fair play to you. But no, a portion of it. So buy to let used to be the golden ticket, right?
Yeah.
So for investing, everyone loved it, making some good returns on it until everything messed up with, tax implications and all of the stuff that's going on. Mm-hmm. Now, the reason why it was golden ticket, low rates, rising prices, easy money.
Yeah,
buy now.
Cheap
money.
Yeah.
But now, higher taxes, tighter rules, shares booming, some say property's dead. Okay, so I want to discuss it on exactly what route would you go down and why. Mm-hmm. And for our listeners out there, then, hopefully we can give some advice on, or our opinion on where they should look at, and why both, what the pros of both, what the cons of both. So if we look at income then, so let's go number one, income, cash in your pocket. So looking at average UK rental yields at the moment, it's about 6 or 7%. Okay, which is quite an improvement actually, because we were looking at sort of 4%. 4 to 5% before. But obviously you lose that to some mortgages, maintenance, letting costs, all of that sort of stuff. Now, if we look at the FTSE 100, pays around 5% in dividends, right? And that's just one of the FTSEs that we're looking at. But with that becomes no headaches, no tenant headaches, no maintenance to pay out for. So the question is, would you rather collect rent or dividends?
I'm from a property background, so I've always put my money in property because I can make the final decision. My distrust of the stock market comes directly from the people who make the decisions, and the people who buy and sell aren't there for your best interest, they're for their best interest. Now, I know over time stock market growth compounds itself and performs well. But if you look at your pension fund or someone's pension fund, very limited amount of trading happens. And the amount of trading that happens, in my opinion, isn't very well done. And I don't have the education all the time to sit on a day-to-day basis and really be able to do it. That's why people call property a passive investment. We know it's not, because you have tenants and stuff to deal with on a day-to-day basis, but that doesn't affect your income, whereas having stocks and shares or trading needs your day-to-day involvement of wake up in the morning, figure out what's going on, make some decisions on a day-to-day, week-to-week basis, particularly in more volatile markets. If you're just sticking £200 a month into a fund, then yes, over the long term it will perform, but short term to medium term, it can go haywire, right? So, and the worst thing people do, like me, is have the app on your bloody phone. It's it's super toxic to have it, the app, and I've got 9 of them or so. Like on your, out. You're constantly checking it. Like, why am I checking this investment fund on a day-to-day basis? Why am I checking how much is in my ISA on a day-to-day basis? Because I'm not going to withdraw it. So why am I checking it? Why is it causing me stress? Why is it increasing my screen time? Whereas a property, you just won't do that. It's just rented until the property manager calls you and say, tap's broken, do you want me to fix the tap? Yes. And you almost make a bit of a decision. Am I going to allow myself to get stressed by my rental property? Or am I going to just allow the property manager to do their job? Same as, am I just going to allow this fund manager to look after the fund?
Yeah.
Or am I going to get stressed by it? And I've not managed to master, just bloody leave it alone when I can with property, because I make the decision. That's the property I'm investing in. That's the tenant I'm having, and then it's away from me from that point. I don't have to think about it. It's just done. I take the advice. The rent goes to this next year. Fine, cool. Sign the contract because it's right. You know, you've done the research for me. So I've always liked property because it's that. But then I've never made a property decision that's lost me money either, because I'm in property. I'm not an uneducated person who just gets sold it by a brochure on a new home site. And you can buy new homes and do really, really well, but you can also not. Yeah. You know, you go into a PD conversion and pay market value for a PD and then suddenly find out that in 5 years' time you can't actually sell it because there's all sorts of problems with the building, the lease, you know, the management, everything. So I think it's a fairly weighted argument. The ultimate answer is hold both.
I mean that'd be the best thing
not the
to
answer
do, right?
You're really looking for on the piece of paper of what would you do. So we obviously ended the last podcast, the How Many Homes Would Raina Buy podcast, and you were pretty much hammering. We had sat on a buy to let podcast, and you were saying I'm tearing my hair out here, with the tax and the implications around landlords. So what would you do?
Well, now I'm looking at it thinking, okay, what you've just said about having a property, you make the decisions on it. But I think seeing things recently, I can see people having an effect on your decision in regards to implementing tax issues, national insurance on rental income, tighter restrictions on your property. So you're losing that bit of control in regards to the renters' rights bill and who's actually protected from it. In more detail, there's still landlord protections, obviously, but I think if you go deeper into it, it's a lot more tenant-sided, and it always has been and always will be. And I think having an asset like that, you know, if the government did something tomorrow or something happened in the world tomorrow that could affect house prices, could affect the way that you think about your property and how you rent it, which has forced you to make a decision that you wouldn't have necessarily made. I think the property route is that you're potentially influenced by other factors. Okay, so in my eyes, it may not be the safest investment that you can make, but that also applies to stocks and shares, because with stocks and shares, you're relying on someone else running that company to, you know, running that company correctly. So there's no negative. I mean, if you've got Tesla shares, you'd be pulling your hair out because you wouldn't know tomorrow whether it's going to go down because Elon Musk has put something on his Twitter that absolutely tanks the share.
You're really good at timing it. They go up by 4% one day, and 4% the next.
But that comes
just sit on your Mac.
That comes into where you've
every day.
You've got to keep an eye on it, right? If you're in stocks and shares. Now, the way that I look at stocks and shares, so if we look at house prices, what's the average increase with house prices over the last 5 years per year? What,
into probably inflationary,
right.
really
so around
basic levels,
around 3%.
Yeah, I would say is fair.
If I look at an index fund or a FTSE 500, let's say, now the average return on that per year over the last 5 years has been around 8.4%. Okay, so I'm outperforming what property is doing. So I'm looking at that thinking, hold on a minute. If I could get that return from putting money in it, and I don't have to have 50 grand deposit to go and buy a buy-to-let property.
Yep.
You know, I can start off with 2 grand, 3 grand, 4 grand, 5 grand.
Yeah.
So the entry sort of level is less, and I can make 8.4% return on that money, leaving it in that fund, so it's compounding every year. Then I look at it and think that's more appealing to me because I'm excited by that. I'm excited by the returns. All right, you have to ride the wave a little bit on things, and it will be up and down. But the way that you can do things now with the apps and you know, with the sign-ups that you use to trade on these platforms is that you can set the entry level.
Yeah.
So as soon as it hits $2, you're buying at $2.
Actually trade off an iPhone.
There you go.
As I've got it here, you know, I'm looking at. You mentioned Tesla, so I thought, I'm going to see what Tesla price has done in the last 12 months. It's gone up 64%.
In the last 12 months?
Yeah.
Okay.
And
I'm talking about 8% here.
I mean, it's just mental.
Like,
yeah. In 12 months, it's gone up 64%. 60% of that in the last 6. So if you're really good at it, you'll do really well to do a property and make it increase in value by 60%.
Yeah.
That's through the transaction.
That's just not...
That's not doable.
No.
But you can also lose money a lot faster.
Yeah.
In the same way. Like, people like Elon Musk he's just... I don't know the right word for it. That's not going to get me in trouble. But
keep it PG, Mike. Keep it PG.
He's obviously a brilliant leader because he's taken Tesla to $1 trillion company, but I feel like he could quite easily destroy it just as fast.
And that's like...
Whether Tesla would allow him now at this point, I don't know. But
and that's what can happen, right? But if you're excited by something, it's a risk worth taking, because I'd be setting levels of when I cash out, when I cash in. I'd have that goal in place of why am I investing this? What do I want to achieve, and by what points do I want to achieve it by? All right, it can tank. If it tanks, you buy more. If it goes up, then you can decide to cash out.
That's the opposite of what a normal person does, right? People normally see it dropping, and I mean, if you start jumping, if
you're investing in stocks and shares and you're seeing it drop, and you're in it for the long term, then I would expect a high percentage of those people to buy more. So you buy when it's red.
Yep, it's fair.
If it's
true, I'm not saying it's not true. I'm just saying how people.
Yeah, you're always going to get people, and that's why some companies do that. They manipulate the cost because they want people to go out, so those shares can go to others, and that especially happens in crypto as well.
I mean, we sit next to each other on the banker desks, and we both hold a holding in a certain thing that suddenly dropped from about $3 to $1.90 a couple of months ago.
Yeah,
and I came in on the Monday and said, "Did you see it drop to $1.90?" And you said, "Yeah, I bought a load of it."
Yeah.
And I didn't, because I just saw it drop to $1.90, and I thought, Andy, that'd be funny. That'd be a funny thing to talk to Andy about on Monday.
And I've gone in and bought more.
Yeah.
It's good news for me.
It's now not $1.90. It's way back $2.96.
$2.96.
There we go. Right, as we're live.
Yeah.
As we're speaking, so you've made 50% on that decision. It just depends. You can't make all of the correct decisions, and you've got to average it out. Whereas I've just got my property plodding away in the background.
Yeah.
To kind of pay for itself until it's gone. What about, if I take this to a real extreme example, Instagram.
Yeah.
Don't own a property.
We're
not talking buy to let now. Talking about chopping your home and rent. So because you've got most of your personal equity is in your house.
Yeah.
Right? Mine is. So if you suddenly released all of that equity from your nice family home to allow you to live your stock market trading dreams.
Yes.
Get a Gordon Gekko suit on and do whatever
Proper
it
get
is
doled
that
up
people
for it.
do.
Proper go
All
to
those
proper
screens,
style.
you know?
10 screens around my
Well,
room.
that's what Instagram's telling me to do. Is owning a home is useless. By the way, I disagree, but owning a home is pointless, and you're wasting your own money
Yeah.
by owning the home. You should be investing it because the compound growth is faster, and that is true because compound growth on your home isn't 8 to 10% a year. I would imagine.
Do you know what? It's funny you say that because I did actually have this conversation with my wife.
How did that go?
A couple of weeks ago, in the fact that, and it was something that I saw from a gentleman called Grant Cardone, who's billionaire. He invests in real estate. He's got all of that sort of stuff. And he was on a podcast, and he said that where the UK, you have people that think that you must own a home. That is the end goal, to own a home. But if you look at other European countries, renting is the normal thing. I think we've got this idea in our heads that renting, no one wants to rent. You're just paying someone else's mortgage. But what this guy was saying is that, well, owning a property, do you actually own it? If you have a mortgage, do you actually own it? Is it an asset or is it a liability?
You don't own it until you own it. You're just leveraging your own income in order to purchase it.
Yeah. So he was classing a property as a liability. And he said normally most people, if you look at wealthy people out there, yes, they invest in real estate through their companies for tax purposes or whatever it is. But actually, those wealthy people more than likely rent a property because of the flexibility that it offers, because they might not be in that country for, all period of time until the taxes change, then they'll move elsewhere. But it gives you flexibility. You've got no mortgage to pay, so you haven't got that 500 grand liability on your head. You haven't got to pay for, maintenance costs or anything like that. So I had a conversation with my wife and said, do we sell this property and invest the equity? Because there's probably about 80 grand in there. So do we take that 80 grand, go and rent somewhere? Because the rent, I could, seen properties to rent that we could easily live in that's lower than our current mortgage, because our current mortgage is quite high at the moment. So could we do that? We invest the rest, the 80k, for the next 5 years, see what the return is that we get, and looking at a FTSE type style investment where you get your 8% average return. And it hasn't really gone below that over the last 5 years. Obviously, it could, but it hasn't right now. And then after 5 years of renting, then do we look to take that out and buy another property, or continue to rent and keep the investments there? So there's a lot of conversations going in, but I think it's worth thinking about on what you do.
Why is it that people do that? I get that people do that. Oh, I'd love to see that they actually do. I get the theory behind it. But then when people reach super wealthy levels, why does a huge amount of that percentage of the wealth go back into property again? It's all it's all invest. But then it all defaults back to then he invests in real estate.
Well, maybe it's just the place to put your money once you hit a certain level, and people have it as an asset then, because they buy the property, so they haven't got a bank. They bought the property outright, and it's theirs.
So we circle back and say, what's your appetite to risk?
Yeah, is the risk.
If you're in a place where you are willing to take that, when you sit down with a financial advisor and you do the risk test, and it's like measured like 1 to 7 or whatever it is, and 7 is like sex, drugs, rock and roll, emerging nations, and 1 is buying government bonds.
Yeah,
1's my mum, I'm about 5 or 6, and then 7 is like you're 26, you're single. You can go and live in Bali, 7 levels. is that where people is that where it is? Like, if you've got no responsibilities, owning a house, I get it, can be a bit of a liability. It ties you to somewhere and it makes it difficult to move around. Whereas obviously holding in a fund or in investments, I mean, you can do that from absolutely anywhere. Just like you can do a lot of jobs now from absolutely anywhere once you've hit a certain experience level.
Yeah.
Is it just that where people will do a full circle? They'll own a property, go, do you know what? Actually, I don't need to live here. I don't want to be anchored here. Check out of that entire system, invest the money, make some money, but then suddenly find themselves back where they started of going, I need to buy myself safety.
Yeah.
And safety sits in bricks and mortar.
Yeah.
So where are you on that?
Yeah, it's exactly that. Circular?
Yeah, I was cyclics. Yeah, whatever it is. Yeah, we'll call it circular.
Our listeners know what you mean.
Yeah. Yeah.
I mean, I got pretty shot down by the missus, so it's not happening. We're keeping out of the house.
Yeah, exactly. You got family jobs, this, that, and
I was just being selfish with it and thinking,
28-year-old. What would 28-year-old Andy do?
yeah. I mean, it would be stocks and shares, crypto, straight in. Don't worry about it. But yeah, look, it comes back to the responsibility level, the goal level. You know, when do you want to retire? When do you want to retire? Obviously, everyone wants to retire as quickly as possible, right? And have that wealth and earn an income from the interest that you get on the money in the bank or the assets or whatever. And I was looking at it and thinking, if we did that, and especially in the thing that I'm investing in at the moment, which you know, Mike, it's like there could be some massive returns on that in the next 10 years. So I should pump the money in there. And I had tunnel vision on, no, it's got to go all in. It's got to go all in. But the reality is, you got kids, you've got a wife, you want the security.
Yeah.
Unless you're planning
the what if questions.
Start
and it's come back.
Unless you're planning to move, it's like, I mean, we're in Wokingham, right? Poppy loves it in Wokingham. Mrs. loves it in Wokingham. I love it in Wokingham. Got no plans to move elsewhere because we don't need to.
Yeah.
So that flexibility option doesn't really apply to us. It's just purely from an investment point of view. If I could get 80 to 100 grand tomorrow, would I put it in buy-to-let property? Would I put it into stocks and shares? Me, because of what my goal is and how quickly I want to put my feet up and relax when I'm older, it would be the stocks and shares route. But from you being in property, 20 years?
20 odd years. Yeah.
You've got that background. You've held property. You rent property out.
Well, I've done
which
I was 28, owned. I think at one point I had mortgage debt which was roughly 20 times my own income as an employee, and I thought it was hilarious. It was like a challenge. It was like complete the Monopoly board. How much debt can I get myself into? Because it was all good debt. I was paying about 2% interest.
Yeah.
And like getting £1,000 rent in, and the mortgage is about 220 quid on each property. So I'm just going to stack these up. Like, why would I ever stop? And then suddenly you find yourself in a detached family home with a big mortgage, with a wife and a child on the way, and you wake up in the middle of the night and go, Christ, I owe over £1 million here. Whoa, and pull back. And it's not a good decision. It's not a bad decision. It's just how it is. It's an emotional part of you that ticks in, that I don't really want to be left at this much risk, which if mortgage rates triple overnight, and kind of did.
Yeah.
You would be in a different place. Now, I wouldn't have lost money because the properties were all performing. I just wouldn't have made money at that point. Went into business instead of owning properties. Now, that's another risk. Which I'm willing to take, calculated gamble, because I had my house behind me. That wasn't at risk. Everything was sort of hived off. It's a limited company, so I know what I'm doing. I've got enough money there to gamble to do that. But I'll go round that circle again at some point, I imagine, as things change. Of going, but I don't know that I'll ever go to the full Instagram extremes of, van lifestyle, like live where you want and just put all the money into that. I'm kind of like, yeah, it's great, but I'd rather have my anchor and not risk everything, which will probably mean I'll never be the highest winner, but I'll never be the loser either. I'll sit somewhere down that middle road or upper middle road, because I've got the opportunities to do it. And it's like you say, you can look at it and go, well, that my wealth, my equity is sat there and it's not really doing anything. I guess that's the frustration for people.
Yeah. And I think that is, like if you look at the returns, that is the frustration of having a, bricks and mortar asset that doesn't really hasn't performed amazingly well compared to, how it was back in the day. But you look at the stocks and shares now and what companies are doing, especially with AI coming into play as well, especially with more people on social media like Meta and the technology companies, and you see the returns, you're like, what am I doing? Obviously you know what you're doing, but there's that thought in your head, why am I doing
that risk? We're in the midst of a .com bubble.
Yeah.
If anyone's old enough like me to remember the .com bubble, where like websites were worth £1 billion, and like Purple Bricks was worth £1 billion, and it was massively backed by a fund. That fund went under. Yeah, because as it turned out, Purple Bricks was worth about 50p. I think it was bought for £1, in fairness. But it just goes to prove there's massive risk and reward in that market. So I think AI is a little bit of a .com bubble. Anyone that says AI at the moment, their stock and their value, their multiple that people buy them at, will just go in comparison to an actual strong firm. No doubt there's some companies out there that are doing wild things that will come out. But if you're going to invest, we don't obviously give advice, but bloody invest wisely.
Yeah, you have to nowadays.
Next 3 years is going to be a something.
I mean, we've seen it before with companies, is that they pop up, say that they're in the process of doing something amazingly well. They've got the prototypes of how it's going to work and all of that, and it's just a rug pull at the end of it. So you get loads of people invest in it. They pull the rug, then suddenly your money's gone. So it's definitely with investing in stock, shares, crypto, anything like that. You have to do your research before, because if you don't, probably 90% of the time you're going to get stung because you don't even know what's going on. But yeah, with the rental side of things, there's still no security there with renting a property compared to owning a property, is there? So if you want the flexibility, well, your landlord could turn around tomorrow and you might need to move property. So you haven't really got a security element there with it. But yeah, it's interesting. It's interesting to talk about. I'm full on crypto at the moment. Have been for a while. But that's just my personal preference. You speak to other people and they want something a little bit safer, like a FTSE out there. But again, depends on your goal. But yeah, I'm looking to quickly put my feet up. So I might be sat here in 5 years' time going, it didn't work out, guys. It all went wrong. Completely ignore episode 280 or whatever it was when I said that what I'm doing is my goal. But I wonder, the money that you put into property back in the day, how much would that be worth now if you put it into stocks and shares? How much do you reckon?
Well, that's what I can't. It's really difficult to fathom because I leverage that money. So what I feel like you can't do. I can buy £250,000 property with 50, 60k and get going. Yeah. And I can't buy £250,000 worth of shares with 50k. It's just different. What are we measuring? Is it my initial investment?
Yeah.
Or is it the property value that I bought? Is it it's apples and avocados?
There you go. We'll end on the apples and avocados. Thank you for listening again. If you like what you hear, make sure that you hit the subscribe button. Make sure that you share it with friends and family as well. And we will see you again in 2 weeks' time.